If you held a bond in your hand and printed right across the top in bold serif letters was the word secured, how would you feel?
Safe. You'd feel safe. That's the instinct.
Right. You'd think if this company goes bust, I own the building, I own the factory, I have a seatbelt.
That is absolutely the instinctive reaction. I mean, secured sounds like a guarantee. It sounds like you have a backstop that makes the investment, well, almost risk-free.
And sometimes that is exactly what it is, but sometimes it's just a label. Sometimes it's a trap, because the real question isn't what the paper says. The real question is, what actually pays you back? Is it cash flow or is it collateral?
And here's the nightmare scenario. If the cash flow disappears, can that collateral, that building, that machine, really be sold?
Right.
Can it be sold for enough money? And, can it be sold quickly enough to make you whole before you lose your shirt?
Welcome to Capital Allocation Lab.
Subscribe and like to support more educational episodes.
This channel is an audio-first library for long-term investors. We are here for the people who want to make calmer, better decisions.
We do that by revisiting classic ideas, especially the dense, heavy tomes from, Graham and Dodd, and translating them into the reality of today's markets.
There's no hype here, no trading signals.
And absolutely no forecasts, just principles, examples, and practical checklists you can actually reuse.
This is episode 10 of our security analysis series, and today we are tackling a topic that sounds dry, but is actually explosive when you get it wrong.
It really is. We're talking about the relationship between the value of property and the amount of funded debt sitting on top of it.
Today's about peeling back the onion on bond security.
We are looking at a deceptively simple topic. When a bond is tied to assets, how much comfort should those assets actually give you?
Or, to put it in plain English, if I lend you money and you promise me your car if you don't pay, does that actually help me if your car is, broken down in a ditch?
That is the perfect framing. We are going to break this down into 4 distinct parts. First, we're going to look at why Graham and Dodd argue that for the vast majority of corporate bonds, looking at asset values is actually the wrong place to start. It's a distraction.
Second, we're going to look at the big exception to that rule, equipment obligations. This is where the collateral is movable, usable, and actually sellable.
Third, we'll move to collateral-trust bonds. This is a fancy term for bonds backed by other financial securities. And we'll see how protective covenants here can matter more than the issuer's, success story.
And fourth, the big one, real estate bonds. We're going to talk about how property value and earning power are connected, why appraisals are often total fiction, and what conservative underwriting actually looks like.
Just one quick note before we dive in. This is educational content only. We are not providing individualized investment, legal, tax, or accounting advice.
Do your own work. All right, let's build some judgment one concept at a time. Let's start with the big principle. The general corporate bond. Think railroads, utilities, big industrial companies. The conventional wisdom is, I want a bond secured by the factory. But Graham and Dodd say, not so fast.
They say that for these types of companies, the bond's safety depends primarily on the company's ability to service the debt.
Okay, so earning power.
Exactly. In other words, the bond gets paid by the business's ongoing earnings and cash flows, not by a theoretical liquidation of the property.
This brings up a really powerful analogy they use. It's the difference between owning a claim on a living organism versus owning a claim on a pile of spare parts.
That is a great image. Think about a business as a living organism. As long as it's alive, operating, making products, selling services, it has value.
It generates cash.
It generates cash. And the bondholder's best outcome always is that the organism stays alive.
Because if the organism dies, if the company fails, what do you actually have? You don't have a business anymore.
Yep.
You have a carcass. You have a collection of machinery, brick and mortar.
Exactly. And here's the trap. When investors hear mortgage bond or lien on assets, they often picture a clean, simple process.
Yeah.
They think, okay, if the company stops paying me, I'll just take the factory, sell it, and get my money back.
Like a foreclosure on a house.
Right. But in real life, for a normal operating company, selling the assets is incredibly messy. And the numbers are rarely as comforting as the brochure.
Let's make this concrete. Suppose you lend money against a massive industrial plant. On paper, on the balance sheet, that plant might have a huge book value. It cost $100 million to build. So you feel safe, lend him $50 million against it.
But book value is just an accounting history. It's a receipt.
It tells you what they spent.
It tells you what they spent. It is not a check you can cash.
And even if you could sell it, a factory isn't like a gold bar. A gold bar is universally useful. Anyone wants it. A factory.
A factory is specialized. I mean, it was built for a particular product. It uses a particular process. It's in a specific location that might not be near anything else useful.
And if the business fails, why did it fail? Probably because nobody wants the product anymore.
Exactly. So if nobody wants the product, nobody wants the factory that makes the product.
Precisely. The value of the asset is correlated with the failure of the business. If the business fails, the plant might be worth a fraction of its original cost.
Sometimes, literally, it's worth more as scrap metal than as a factory.
And even then, even if you manage to sell it for scrap, you're not the only person standing in line with your hand out.
Oh, not at all. You might have unpaid taxes. Those usually come first. You might have environmental liabilities. Maybe that factory leaked chemicals into the groundwater.
That's a massive cost.
Huge. You might have labor claims. You have a long line of creditors.
So the lien that you thought was a seatbelt
Becomes a lawsuit. It becomes a 3-year legal process where lawyers burn through whatever cash is left.
This is why Graham and Dodd are so skeptical about general bond safety tests based on property values. They really hammer home this idea that you cannot view the assets in isolation from the enterprise's success or failure.
They even take a swipe at statutory rules. Historically, there were laws that tried to legislate bond safety.
Right.
For example, a rule saying a utility bond wouldn't qualify for certain investors unless the pledged property value exceeded the bond issue by 2/3.
Which sounds sensible on first hearing. Make sure the assets are worth much more than the debt.
It's just common sense, right?
It is common sense, provided you know what value means. The problem is how you measure it.
Okay.
If the value is just book value, original cost minus depreciation, or worse, some artificial value from a corporate reshuffling or a generous appraisal, it creates a number that looks safe but means nothing.
It's a false precision.
Exactly. It's measuring the wrong thing.
Let's pause for a second and define a few terms we're going to be throwing around just so we're all on the same page.
Liquidity.
Funded debt. We hear this a lot in old finance texts.
Funded debt is essentially long-term debt. Bonds, debentures, obligations that don't come due right away. It's the permanent capital borrowed by the company.
And asset coverage.
Asset coverage is a ratio. It's the total value of the assets divided by the amount of debt. It tells you how many dollars of stuff back up every dollar of debt.
Right, and you'll also hear loan to value, or LTV.
Which is just the reciprocal. Debt divided by value.
Now, in some lending contexts, like a home mortgage loan to value is everything. It's a powerful risk control.
But for most operating companies, loan to value based on book numbers can create the illusion of safety without the substance.
So, if we can't rely on the liquidation value of the factory, how should we think about safety? What is the forward-looking way to analyze this?
You have to ask a brutal question. Ask yourself, if markets disappeared tomorrow, no stock prices, no credit ratings, no headlines, what would still make this bond safe?
And the answer isn't a line item called property, plant, and equipment.
No. The answer is, can the business, through a normal business cycle ups and downs, generate enough cash to pay the interest, cover the required debt amortization, and still maintain the assets that produce that cash?
So it's not just earnings in a vacuum, it's durable earning power. Exactly. And you can hear the owner's mindset here. If you were buying the whole business, not just a bond, you would ask, what are the economics?
Sure.
What is the competitive position? How cyclical is this industry? What does the balance sheet look like?
You wouldn't say, well, the factories cost $1 billion to build, so I'm safe paying $800 million for the business.
You'd be laughed out of the room because you know that cost isn't value unless a buyer exists at that price.
There is one nuance here, though. Graham and Dodd aren't saying collateral never matters.
No, they aren't. They're saying, for the ordinary corporate bond, relying on pledged physical property as the primary test is usually misguided.
Right.
But that sets up the rest of the discussion, because they immediately pivot to special obligations where the collateral is different.
Where the collateral is more mobile, more liquid, more separable.
So the key mental model we're going to use for the rest of this episode is this. A bond can be protected by one source of repayment or two.
Source 1, the issuer's cash flows, their ability and willingness to pay you from operations.
Source 2, the collateral, what you can seize and sell if the issuer doesn't pay.
For the typical corporate bond, Source 1 dominates. Source 2 is often, well, a mirage.
But for certain asset-based obligations, Source 2 is real enough that it can carry much of the risk, sometimes almost like a pawn loan.
And that takes us to the first big exception, equipment obligations.
Equipment obligations are fascinating because they show a different kind of security. In the classic example from the book, instead of a lien on a whole railroad system or a giant industrial plant, you have a claim on specific, identifiable pieces of equipment.
We're talking locomotives, freight cars.
Passenger cars, the rolling stock.
And the key word there is rolling. It moves.
Yes.
That separability is everything. It changes the bondholder's negotiating position completely.
Let's play this out. Imagine a railroad mortgage on the track and the right-of-way. That sounds super secure. I have a mortgage on the land.
Right.
But if the railroad is in trouble, can the bondholder realistically say, fine, you missed a payment. We're taking the track back tomorrow?
No. What are you going to do with 100 miles of track between Kansas City and St. Louis? You can't move it. You can't sell it to a bakery.
Exactly. The track is tied to the whole system. Its value comes from being part of that specific network.
So the bondholder is basically held hostage.
Right.
They are forced to let the railroad or a receiver in bankruptcy operate the line because that's the only way to preserve any value at all.
Exactly. But equipment trust holders, they have a credible alternative.
Okay.
They can say, you didn't pay. Okay, we are taking the engines, we are taking the boxcars, and we're going to lease them to the railroad next door.
And that threat, whether or not they actually do it, changes the borrower's behavior.
It changes everything. It's the difference between lending against a custom-built machine bolted into a concrete floor versus lending against a fleet of Ford F-150s.
If the borrower stops paying on the fleet of trucks, you repossess them. You drive them off the lot. You sell them at auction.
Right. They have a market value independent of the borrower.
Graham and Dodd emphasize that this mobility gives equipment obligations an advantage similar to loans on chattels, things like jewelry or cars.
It's closer to a pawnbroker model.
That explains why, historically, these equipment trusts had such a strong reputation. Even when railroads were in serious financial trouble, receivership, bankruptcy, they often found ways to keep paying the equipment obligations promptly.
It wasn't because management was kind-hearted. It was because the alternative, losing the equipment, was unacceptable.
Yeah, you can't run a railroad without trains.
You can't. So in this case, the investor effectively has two real sources of protection.
Okay, what are they?
Source 1 is the same as any bond, the credit and success of the railroad. But Source 2 is the value of the pledged equipment itself.
And if Source 2 is large enough relative to the loan amount, the investor can lean less on the railroad's credit.
Let's talk about the structure, because
Yeah.
the structure is where the safety really lives. It's not just that the trains are movable, it's how the deal is written.
Equipment trusts are typically designed with legal forms that make enforcement easier.
Yeah.
But the financial terms are where it gets interesting.
They usually require an equity cushion from day one.
Skin in the game.
Exactly. In many classic cases, the railroad contributes at least 20% of the equipment's cost upfront in cash.
So the debt is initially no more than 80% of the equipment cost.
And then, and this is critical, the principal is usually amortized.
Okay, what does that mean?
That means paid down in equal annual installments over about 15 years.
That is a huge difference versus many corporate bonds, which are often interest only until the very end, with a massive bullet payment at maturity.
Right. With amortization, the debt balance falls year after year. Every year, you owe less. And if the equipment's value depreciates at a normal pace, the loan-to-value often improves over time.
Here's a simple intuition for the listeners.
Oh.
Imagine you buy a $100 train car. You borrow $80. Every year, you pay back roughly $5 of principal.
Right.
After 5 years, you only owe $55. Even if that train car is now worth $70, you're still fully covered.
Exactly. There is a built-in path toward lower leverage.
Now let's bring this into the modern world. We aren't buying steam locomotive bonds anymore.
Yeah.
Where do we see this today?
You see it everywhere in transportation finance. Aircraft finance is the big one-enhanced equipment trust certificates, or ETCs.
Oh, sure.
You see it in shipping containers, rail car leasing.
The common thread is standardization and alternative use. If the asset can be used by someone else with minimal modification, it retains independent sale value.
A Boeing 737 is a Boeing 737, whether it's flown by United or Delta.
But, and this is a big but, Graham and Dodd are careful. They don't call equipment trusts magically safe.
No, they acknowledge that conditions can change.
What breaks the model?
Two big forces. First, broad price declines. If the cost of building a new train car drops by 50% because steel gets cheap, the value of your used train car drops too.
Right, replacement cost sets the ceiling for used value.
Exactly. Second, and more dangerous if the industry's demand for the equipment collapses. If rail traffic falls sharply across the entire country, then nobody needs extra boxcars.
Suddenly, that liquid market you were counting on evaporates. You can repossess the cars, sure, but who are you going to sell them to? Everyone else has too many cars, too.
The chapter gives concrete examples of this. Under stress, even equipment obligations can face workouts.
Meaning, instead of getting your money back instantly, you get dragged into a negotiation.
Right. Some railroads in receivership required holders of maturing equipment obligations to extend maturities temporarily, or to swap into new certificates with lower coupons.
And they mentioned a particularly stark case where equipment trust holders were allowed to take over and sell the pledged equipment. They exercised their right. And what happened?
The recovery was far below par, around 43 cents on the dollar.
That one number, 43 cents, is enough to puncture the myth of absolute safety.
It is. The right lesson is not equipment trusts are risk-free. The lesson is asset realizability is a massive advantage, but it is still subject to market conditions.
It works until the whole market stops working.
But even then, the market recognized the difference. They note that at one point, new equipment trust certificates of a railroad sold at very low yields, meaning high prices, despite the railroad's mortgage bonds being in default.
That is the market expressing the distinction clearly. We trust the trains, we don't trust the tracks.
So how do we translate this into a practical framework? If you are looking at an asset-backed bond today, what do you ask?
Let's build a checklist. 5 questions.
Go for it.
Question 1. Is the collateral identifiable and legally separable? Do you have a clear claim on specific serial numbers, or is it a vague lien on property?
Question 2. Is the collateral mobile and usable by others? A movable standardized asset is liquid. A custom asset is not.
Question 3. What is the starting equity cushion? Did the borrower put their own skin in the game?
Question 4. How fast does the debt amortize relative to realistic depreciation? You want the debt to shrink faster than the asset rots.
And question 5. In a downturn, who has leverage? Can you actually repossess, or will you be pushed into extensions?
I'd add one more for the modern era. Correlation. How correlated is the collateral value with the issuer's distress?
Yeah, exactly.
If the issuer fails because the whole industry is dying, your collateral is probably dying too.
Perfect. Now, let's pivot to the next type. We've done physical equipment. What about financial assets? This brings us to collateral trust bonds.
Collateral trust bonds sound straightforward. They are bonds secured by a pledge of stocks or other bonds.
In the classic corporate setting, a big holding company might issue bonds and pledge the stock of its subsidiaries as collateral.
And in those cases, frankly, the collateral structure doesn't add much because the value of those subsidiary stocks rises and falls with the success of the enterprise.
Right, it's all the same bet.
It's all the same bet.
Yeah.
If the parent goes bust, the kids are probably bust too, so the collateral doesn't diversify your risk.
But Graham and Dodd point out a special case that is extremely important. Collateral trust bonds issued by investment companies.
In this setting, the collateral isn't a subsidiary operating a factory. The collateral is a portfolio of marketable securities.
Stocks and bonds of other companies that can be sold for cash on the New York Stock Exchange.
Now the game changes. The bondholder's primary concern shifts from, will this company earn enough operating profit, to, is the portfolio worth enough, and can the contract force action before the cushion disappears?
This is where protective covenants become the absolute core of safety.
Let's define that. Protective covenants are the rules of the road written into the bond contract. They limit what the issuer can do, and they trigger remedies if things go wrong.
In this investment company structure, it works like a built-in margin call.
Exactly. Let's do a toy example. Suppose an investment company issues $100 million of bonds. The indenture, the contract, might require that the market value of its portfolio stays at or above $150 million at all times.
So that's 150% coverage requirement.
Right. Now suppose the market crashes.
Yeah.
The portfolio value falls to $140 million. The covenant is breached.
What happens?
The company must cure the deficiency. They have to fix it. Usually they have to sell assets and use the cash to pay back bonds, or they have to raise new equity to top up the account.
The core idea is forced deleveraging.
Yes.
The contract forces the company to shrink the debt to match the shrinking assets.
And notice what that implies. The bondholders can be protected even if the shareholders get wiped out.
That is a crucial distinction. Usually we think of bondholders and shareholders as being in the same boat. If the boat sinks, everyone gets wet.
But here, the shareholders might drown, but the bondholders stay dry.
Graham and Dodd give a dramatic historical example of this. There was an investment enterprise that was a total disaster as a business story. The stock price fell from a peak of around 69 down to about 1.
That is a 98% loss, a total wipeout for the owners.
But the bonds, because they were covered by marketable assets and governed by these strict covenants, they held up.
The structure compelled the company to repurchase more than 3/4 of the bond issue as the assets shrank.
It forced them to pay back the debt while they still had the money.
And it even forced shareholders to inject more capital to try to save their stake.
Which is an inversion of the usual narrative. Usually bondholders are the ones begging for scraps.
Exactly. Here, the contract forced the shareholders to bleed to save the bondholders.
The bond prices reflected that reality. At one point, when the stock was trading at $2.50, the bonds were trading at 88.
And later, the remaining bonds were called above par around 104 1/4.
If you are listening and thinking, how is that possible? The stock went to 0 and the bonds got paid 104.
It is because the claim was tied to realizable liquid assets and backed by covenants that were actually enforced.
A covenant you don't enforce is just a suggestion.
Correct. The strength of a bond isn't only about the issuer's intentions, it's about the bondholder's rights.
Where do we see this today?
You see analogs in closed-end funds, business development companies, BDCs, and other investment vehicles that issue debt.
Okay.
They have strict asset coverage tests mandated by regulation or contract.
You also see it in the repo market. Securities-backed lending. The whole system runs on this logic. Mark the collateral to market every day, and if it drops, make a margin call.
But there's a warning here, too. Liquidity is a fair-weather friend.
Yeah.
When assets are liquid, they can be sold quickly. But in a true crisis like 2008 or March 2020, liquidity can vanish. Prices can gap down.
So if your covenant says sell assets if they drop, but there are no buyers,
Then you have a problem.
which brings us back to the checklist mindset. For collateral trust bonds, you need to ask, what exactly is the collateral? Is it truly diversified and marketable?
Or is it just a bunch of affiliated companies?
Right. And how is it held? Is there a trustee?
What are the coverage tests? And critically, what are the remedies?
And finally, who enforces it?
Exactly.
Okay, we've done factories, we've done trains, we've done stocks. Now we have to talk about the biggest, most emotionally charged category of them all, real estate bonds.
Real estate. This is where the word security feels the most literal. You can walk up to the building, you can kick the bricks.
And because it's tangible, investors often trust it more than they trust a business model. You know, it's real estate. God isn't making any more land.
But Graham and Dodd make a very sophisticated point here. They say that in real estate, the property's value is deeply, inextricably connected to its earning power.
Meaning its ability to generate rent.
Exactly. A building that no one wants to rent is just a pile of bricks that you have to pay property taxes on. It's a liability, not an asset.
So even here, value isn't just bricks and mortar. Value is rent. Value is occupancy.
They call it going concern value. The value is derived from the cash flows it can produce.
Let's walk through the math. They give a simple mortgage example that clarifies everything.
Picture a single-family home. Let's use simple numbers. The home costs $10,000. Under ordinary conditions, it rents for $1,200 per year.
Okay. But the landlord has expenses. Taxes, repairs, insurance. Let's say those are $400 a year.
So the net income, the cash in the pocket, is $800.
Now let's slap a mortgage on it. A classic first mortgage at 60% of value, so a $6,000 loan.
Let's say the interest rate is 5%. So 5% of $6,000 is $300 a year in interest.
Now look at the coverage. You have $800 of net income to pay $300 of interest.
That's coverage of about 2.7 times. You have almost $3 of income for every dollar of interest. That looks safe.
But let's stress test it. How much could rent fall before the lender starts to worry?
Well, expenses are usually fixed. You still have to pay taxes. So if rent falls, the net income falls dollar for dollar.
We need $300 to pay the interest. Expenses are $400, so we need a total of $700 in rent just to break even on interest.
The current rent is $1,200. It can fall to $700. That's a drop of $500.
Which is a 42% drop in rent.
That is a massive margin of safety. Rents rarely drop 40% overnight.
And here's the lender's reasoning. Even if the current homeowner goes broke and can't pay, the lender assumes there will be another buyer or another tenant who will step in.
Because homes are broadly usable, everyone needs a place to live, the market is deep.
Now compare that to the industrial plant we talked about earlier.
A factory might also cost $1 million and have a $600,000 mortgage. same 60% ratio.
Right.
But if the company goes bankrupt, can you rent that factory to someone else?
Probably not.
So the usability of the asset is just as important as the numbers.
Now, Graham and Dodd pivot to a major historical failure, the real estate mortgage bond boom of the 1920s.
This is a classic financial bubble, and the mechanics of it are timeless.
During that boom, bonds were sold based on a single magical headline number, the appraised value.
And that appraised value almost always exceeded the mortgage by a healthy margin. It looked conservative.
But where did the appraisal come from?
It was engineered. The common technique was to estimate a very high rental income, often higher than current market rates, and then capitalize it at a generous rate.
Basically, they said, this building will earn a fortune, therefore it is worth a fortune.
Right. So a building that actually costs $1 million to build might be appraised at $1.5 million the day it opened.
And then they would issue bonds for $1 million.
Which looked like a safe 66% loan to value based on the appraisal, but in reality, it was 100% of the cost.
The promoter, the guy building it, didn't have to put up a dime of his own money. He borrowed the whole cost.
Sometimes he even borrowed more than the cost and pocketed the difference as cash profit on day one.
That is not conservative finance. That is a transfer of risk.
Yes. The public takes all the risk, the promoter takes all the upside.
And what happens when you let people build with free money?
They build too much.
Exactly. Overbuilding. High rents invite supply. New supply crushes rents.
So interpreting temporarily high rents as proof that a building is worth 50% more than its cost is a classic extrapolation error.
And it gets worse. Overbuilding dries up construction costs. Labor gets expensive. Materials get expensive.
So the cost itself becomes inflated.
The bubble on top of a bubble.
Graham and Dodd are scathing about this. They point out that investors failed to discriminate between general-purpose buildings like homes or standard offices and specialized buildings.
Hotels, garages, clubs, hospitals, churches.
These are specialized structures. Their value is tied entirely to the success of the specific business operating inside them.
A hotel isn't really a real estate play. It's a hospitality business.
Exactly. So a mortgage bond on a hotel is, in substance, a corporate bond. It should be judged by business standards, management, margins, competition.
Instead, people judge them like they were lending on a house. It's a big stone building. It must be safe.
And when the hotel failed, the bondholders found themselves owning a massive empty building with high maintenance costs and no tenants.
Another huge problem they highlight is information, or the lack of it.
Opacity. Many of these bonds were issued by private companies. Once the bonds were sold, the investors got zero information. No quarterly reports, no balance sheets.
So you're flying blind.
And while you were blind, the owners were often extracting cash. Graham and Dodd used the phrase milking the property. They would defer maintenance, stop paying property taxes, and pull every dollar of cash out for themselves.
By the time the bondholders realized there was a problem, the building was run down and owed 3 years of back taxes.
Opacity is a form of leverage. The less you know, the more you are relying on trust, and trust is not a covenant.
So what is the solution? How do you lend on real estate without getting burned?
They propose a set of strict rules.
Let's modernize their checklist.
First, for homes. Keep the loan amount meaningfully below true value. They suggest a maximum of roughly 2/3 of value.
And crucially, value based on a fair price, not a speculative bubble price. If the market is frothy, lend less.
Second, for new commercial buildings. Ignore the promotional appraisal. Look at the cost.
The real cost.
The real verified cost. The bond issue should be no more than 2/3 of that.
Meaning, the equity owner needs to put up at least 33% of the money. Real skin in the game.
Third, earnings cushion. They want to see net income covering interest by at least 100%. That's 2x coverage, and that's after deducting a real depreciation allowance.
Depreciation matters in real estate.
Huge. Buildings wear out, roofs leak, boilers break. If you aren't reserving cash for that, you are lying to yourself about your income.
And they want that depreciation money used as a sinking fund to pay down the debt.
Again, amortization, reducing the risk over time.
Fourth, transparency. If they won't show you the books, don't lend them the money.
They also mention a tricky structure. First, leasehold mortgage bonds.
Oh, these are a trap for the unwary.
They are. This is where you lend against a building that is built on lease land. The building owner doesn't own the dirt. They pay ground rent to the landowner.
And that ground rent is a senior claim. It gets paid before the mortgage.
Which means your first mortgage is economically a second mortgage. You are behind the ground rent.
So in your analysis, you have to treat the ground rent as a fixed charge, just like interest.
Finally, they talk about qualitative factors.
Yeah.
Location.
Location.
It's a cliche because it's true. They tell a story of a well-financed office building in a major financial district. It looked perfect. Strong coverage. Conservative loan.
But the neighborhood changed.
The center of gravity shifted. Tenants moved uptown. Rents fell. The bonds defaulted.
The lesson being, quantitative cushions can be overwhelmed by qualitative deterioration.
If the neighborhood dies, your spreadsheet doesn't matter.
So let's wrap this up with a synthesis. We've covered a lot of ground: corporate bonds, equipment, collateral trusts, real estate. How do we bring this all together?
If you only remember one thing from this deep dive, it should be this. Most bonds are paid by earnings power, not by appraisals.
Right.
Collateral is only as good as its realizability and the contract that lets you realize it.
Let's give the listeners a decision tree, a mental flowchart for when they see the word secured.
Okay. Step 1. Identify the true primary source of repayment. Is this bond meant to be paid from operating cash flow or from selling assets?
If it's operating cash flow like a standard corporate bond, your analysis should focus on business durability, interest coverage, cyclicality.
Step 2. If collateral is part of the story, ask, is it truly separable and marketable?
Is it a train car? Good. Or a customized factory? Bad.
Step 3. Stress test the value. Don't use book value. Don't use the appraisal. Ask, what is this worth in a fire sale?
Step 4. Look for structural protection, equity cushion, amortization, covenants.
And step 5, transparency. Never lend blind.
And let's boil it down to 3 rules of thumb.
Rule 1. For ordinary corporate bonds, don't let asset coverage distract you from cash flow coverage. Cash is king.
Rule 2. When collateral is real movable equipment or liquid securities, study the legal enforceability and the haircut. Can I actually get it?
Rule 3. In real estate, treat appraisals as hypotheses, not facts. Underwrite the rent, the expenses, and the location.
If you stick to those rules, you will avoid the vast majority of bond traps.
And honestly, you'll be a better equity investor too, because understanding the downside helps you value the upside.
That is the capital allocation lens.
Before we go, a quick preview. Once you start caring about protection and enforceability, you inevitably run into covenants.
Protective covenants, what they are, how they work, and how companies try to wiggle out of them. That is a whole universe.
It really is. We'll cover that in future episodes. Also, if you want, we can do a practical case study. Pick a real company, map its debt stack, and figure out who is actually safe.
If that sounds useful, tell us in the comments.
Or tell us what topic you want next. Margin of safety, fixed charge coverage.
Or we can do a follow-up on real estate specifics, cap rates, vacancy assumptions. Let us know.
All right, outro time.
Capital Allocation Lab exists to teach disciplined, long-term investing by revisiting classic books and core ideas explained clearly in today's context so you can make better decisions as an owner.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
And if you have questions or there's a fundamental concept you want us to unpack, drop a comment. We read them.
Until next episode, stay patient, stay curious, and think like an owner.